All right, hello everyone. Hope you're having a good day. I have two special guests. My daughter, Ava. Say hi, Ava.
Hi.
And our chief canine officer, Clifford, is laying on my feet. So, Clifford, you smell it. You need a bath. Ugh. All right, anyway. All right, so we've had this massive move up. I'm seeing some things that may make it move lower. This is the S&P 500. This is what we call a benchmark. And I'll start right here with the sentiment. Okay, so we've reached an extreme in sentiment again. We have 51% bullish and 19% bearish. That's extremely low. The last time we were this high was back in July for the bullish. Now, here's the thing: if a lot of investors are bullish, or if the overwhelming amount of investors that there are bullish, that means they think the market's going to go up. Okay. If the vast majority of investors are bullish, what do? They spend their money, they invest their funds, and then the market runs out of buyers, and then the only way it can go is down. So I'm going to bring up the S&P 500 and show you the last time investors were as bullish as they are now. And look at that. It's right there, right at the very, very, very top. So people are really bullish. They think the market's going to keep going higher. They end up investing all their available funds, and the market runs out of buyers, and the only way it can go is lower. Sentiment signals are contrarian. If an extreme amount of people are bullish, or if an extreme amount of people are saying, oh, you should buy the latest crypto, well, that tends to be a bad thing because the market runs out of buyers. It's opposite on the downside. Look at the most bearish people were in the last year. Actually, we're getting pretty close there. 1221. Perfect time to buy. All right. So there's a couple things going on here which I think we need to look at, which might give us a little bit of a signal that the market's about to go lower. Now, if I'm long, if you're long, I would just stay long. But just be careful because with the sentiment the way it is, we could have a pretty quick reversal. One of the things that could be driving this, or probably will be driving it, is interest rates. As we know, unless you've been under a rock, and unless, depending on, and maybe even if you were under a rock, depending on what rock it is, these interest rates going lower have been bullish for the market. So I'm going to explain this to my daughter. So higher interest rates are considered bad for a market because for the stock market, because the stock market is the companies that are in it, or the stocks that are in it. Companies have to borrow money to function. At Walmart, for example, they don't just take money out of the cash register to pay their employees. They have to borrow money from banks in what we call a in a short-term deal, or what we might call the overnight market or the commercial paper market. But regardless, if a company needs to pay more money to borrow money, that money comes right out of the bottom line. The fees they have to pay to borrow that money comes right out of the bottom line, and of course, the money they borrow they have to return. So the market perceives interest rates going lower as a bullish thing for the market, and that's what's been going on. So we can see here the 10-year yield has made a pretty significant move lower. Now, here's a catalyst I think that we need to watch. I'm going to bring up uh, the ETF of the bonds. Okay, this is the what is this? This is the iShares 20-year bond fund. Now, notice where it is. Okay, notice how it's at this particular price level, which makes sense. $100. People like psychological levels. People say, "Oh, if it gets to 100, I'll buy it." Things tend to get to resistance. This is what we call resistance, Ava. See up here?
Yeah.
Resistance is when a market's going higher, there's not enough supply. There's not enough supply, and the demand overwhelms the sellers, or the buyers overwhelm the sellers, and they have to push the price up. But when we get to resistance, all of a sudden there is enough sellers. There's enough supply to fill all of the demand. And sometimes the traders notice, hey, the price isn't going any higher. I want to sell. So I better be willing to sell at a lower price than anyone else is because the buyers are going to go to whoever wants to sell at the lowest price. So you get these sellers that start to get nervous and anxious that they're going to miss out. So they start to undercut each other and you get these sell offs. So when we get to resistance, we tend to sell off because you have anxious sellers that are afraid. Like, for example, if you're willing to sell something at 109 and someone else comes along and says, hey, I'm willing to sell it at 108, who do you think the buyer's going to go to? They're going to go to the person who wants to sell it at the lowest price. Now, the opposite is true when you get to support. Support is where you have a large amount of buyers. Market's going lower, there's not enough demand or buyers, so sellers are forced to push the price lower. And when we get to support, for whatever reason, that's where the buyers are. Now, some of these traders that want to buy start thinking, gee, it's not going any lower. There must be new buyers coming in. So they start to bid higher because the sellers are going to go to whoever is willing to pay the highest price. So you come off of resistance and you come off of support because of this psychological aspect, right? Markets are all about psychology, and that's what I've just been explaining to my brilliant young daughter here. Yeah, you know, the apple does not fall far from the tree. All right. So now, here's the thing to watch. Notice how we have gotten up to a level that is probably going to be resistance. There are people that bought back here when this ETF, TLT, was around 100, and they thought they were all that, as my daughter would say, when the market went up. But that's what we should name our fund, maybe, all that fund. But then when the market goes lower, a lot of these traders are like, what the hell, man? I made a mistake. What did I do? I'm underwater. I'm going to wait. If this thing gets back up to my price level, I am going to sell if I can get out of break even. So you have the people that bought around this level back in July and back in February and back in January. Now the price is back up to their buying price. So there's a lot of remorseful buyers who want to sell. So that's why we ran into resistance here. That's why all of a sudden there was enough supply to fill all of the demand. Now, if we get the same thing that we saw back here, where the sellers start undercutting each other, that's going to push bonds lower, and that could push interest rates higher. Okay? So low interest rates are good for our market, at least the stock market in general, and the opposite is true. So if we start to start to come lower here, that means interest rates are going up. Consider where the sentiment is. The market's really running out of buyers. Everyone's talking about the Santa Claus rally, blah, blah, blah. When everyone's on the same side of a trade, it tends not to work out because once the market runs out of buyers, then it's not going any higher. So I'm watching this for a reversal as a catalyst to the market sell-off. Now, we can't act right away. We have to wait for the reversal to start. Don't just go out there and selling stuff right now because the market could keep going higher. We jump in when the reversal starts. We wait. We're pause probably for a decent move to the downside. But it's too early to get in. You have to wait for the reversal. So make sure you check back in with us here on my YouTube page. Now, the one other thing I think is the most important thing to watch is what's the action in the financial sector. The S&P 500 is 11 sectors, and different sectors are kind of in control in different times. They're in the driver's seat at different times. Here's the financial sector. I think that if interest rates start to rally, in other words, if bonds sell off of that resistance level, and if the financial sector comes back below this 37 level, there's a good chance it's going to keep going. We know a lot of times that what was resistance here, like here, this is just an example, can turn into support. This is seller's remorse. There's people who sold. When the price goes higher, a lot of them are like, I made a mistake. If it gets back to my price, I'm going to buy my shares back. If this 37 level does not convert into resistance, there's a good chance that it goes lower, okay? And there will be money to be made on the short side. And you don't need to be an options trader. You can look into inverse ETFs. So make sure you check me out at the Benzinga Trading School, because I talk about, it's not just me, we have a community. We talk about this stuff every day. This is just really a good example here of this importance of certain price levels. I mean, check this out. You don't need to be a market guru to see. This level became support. People bought, goes lower. They're like, if I can get out of break even, I'm going to. So enough remorseful buyers placing sell orders convert support into resistance. And then here we see resistance converting into support. We have enough people that sold who are remorseful, that regret selling, that are going to buy back their shares. So if you have enough remorseful sellers placing buy orders at the level that was resistance, it can convert from resistance into support. So that's what we're going to be looking for here. If it doesn't happen, I think there's going to be some trades on the short side. And, even if you're not an options trader, there are ways to make money. Like, for example, you can look at this ETF here, FAS. This thing is designed to move in the opposite direction of financials by about 3%. So if financials go down 2%, this will be up, say, 6%. I think the financial sector is looking a little bit weak. And here's what I want you all to focus on. And again, we're going to be talking about this tomorrow, and we're going to be talking about it in my training class. If we look at the members of the financial sector, the biggest stock is Berkshire Hathaway, Warren Buffett's company. And if we look at the chart of that, it really doesn't look that impressive. It's just kind of hanging out, okay? If we look at MasterCard, it's just kind of hanging out. This looks kind of neutral. These are the biggest stocks in the sector. But notice JP Morgan, notice Bank of America. These things are very overstretched. They're overextended. People have been buying them like it's going out of style. They're overbought, which means they're trading at a level that's above their usual or typical trading range. This bottom half of the chart here shows you, it's one way to measure momentum. And see how we're at this blue line up here? We go all the way back for like years. And financials have not been as overbought as they have been since November of 16. So we're extremely overbought. That's going to bring sellers into the market on this particular stock. And we see the same things in the bank. So in other words, the financial sector is moving up because the banking industry has been very strong. But other parts of the financial sector have not been that strong. And if these banks start to reverse, that's going to put our financials probably to break that level I talked about. And if we consider the sentiment, we consider interest rates, we got to be paused for some kind of a reversal here. So if you're long, stay long. As a trader, the trend is your friend. We just stay with it. But if we start to see these reversal signals, it probably makes sense to kind of position yourself for the short side. So make sure you check back in the morning. Make sure you check out the Benzinga Trading School, and I will talk to you soon. All right, everyone. Thank you.